Welcome everyone to this RaaS Research Group stock take webinar, where we will dive deep into the analysis of a promising ASX-listed stock. Today, we're focusing our attention on Kinatico, ASX KYP, a Know Your People technology company helping employers to manage their workforce and meet their regulatory compliance needs. Some of the largest employers in Australia and New Zealand rely on Kinatico solutions to ensure they have the best people in the right jobs where they need to be. RaaS Research Group's detailed analysis will be presented by Senior Analyst Finola Burke, and she will cover all the main themes, financial models, and potential pitfalls any scrupulous investor should consider before making an investment decision. This presentation will then be followed by Kinatico's CEO, Michael Ivanchenko, CFO Jason Margach, and Chief Revenue Officer Geoff Hoffmann, my apologies, providing a detailed presentation. After their presentation, we will have a live Q&A session. So please feel free to submit your questions using the Q&A function on your screen throughout the webinar at any time. I'll be collecting these questions and putting them directly to our presenters during the Q&A segment. Thank you for joining us, and without further ado, let's get started. Please join me in welcoming RaaS Research Group Senior Analyst, Finola Burke.
Thank you, David, and thanks to the Tech Investor team for putting on this event for us. Let's move on to slide 3 of my presentation. I'm sure everyone's familiar with disclaimers. So our plan today is to have a look at some of the key elements of the 2024 results. We'll discuss the recurring revenue generated in FY24 and our forecasts. We'll look at what other companies to consider as peers for Kinatico, what they're trading on, and the multiples paid for recent acquisitions. Finally, we'll round off on our valuation and discuss the key sensitivities and risks in our modelling. Next slide, David. So onto the FY24 results. The new information for me in the results was that the company broke out transactional annual recurring revenue for the first time. And this was $12 million of the $19 million reported in transactional revenue, which has traditionally been viewed as one-off as opposed to ongoing SaaS revenue. And the $12 million of recurring transactional revenue was from corporate customers who are 91% returning customers. The other key takeaway for me was that there were many more companies and enterprises who are now customers of Kinatico. So I believe Geoff Hoffmann will touch on that later. Next slide, please. So in addition to the recurring transactional revenues that Kinatico reported, the company also generated a significant lift in subscription revenue, which now accounts for 34% of total revenue. So we're forecasting subscription revenue to rise to 60% of total revenue by FY27. The company has set a target of getting to 80% in 3 years' time, so we may well prove too conservative in our forecasts. If we put transactional and subscription revenue together, we're forecasting ARR to rise from 76% of total revenue in FY24 to 85% in FY27. And this includes our expectation that we'll see a drop in transactional revenue with this shifting to SaaS revenue over time. We'd also expect to see an overall reduction in one-off revenues. Next slide, please, David. Some other important considerations from the FY24 result are around the quality of the result. We saw it as a very high quality result. In addition to both gross margin, EBITDA margin, and NPAT increasing, all good signs that the company is performing well operationally and has good handle on costs. We also saw a strong increase in return on invested capital, which I always like to look at as a balance sheet measure, as it strips out the impact of events such as buybacks and really provides a good measure of how much the company is working shareholder assets. As you can see from our table, there's been a marked improvement over the last 3 years, and we're now forecasting a strong rise from FY25 to FY27 as the company's ability to generate its own capital needs while growing the business comes to the fore. I'll also note that the EBITDA as a percentage of operating cash flow has improved over the last 3 years. Again, I like this measure because it really shows what cash is being generated as opposed to operating profit. And as you can see, the company went above 90% for the first time in FY24. And that, again, we see that as a very high quality move. So with ongoing profitability, more tax to pay, we'd expect EBITDA as a measure of operating cash flow to exceed operating cash flow over the next 3 years. And lastly, from a liquidity perspective, current assets are now at 2 times current liabilities. We expect that again to rise over time. Next slide, please. So on to peers. We've looked at the Australian listed SaaS and transactional platforms which report ARR, and we identified 13 companies in total. They are all at varying sizes in terms of market capitalisation, and they also are at varying stages of profitability. In fact, only 5 are profitable, and that's RPM Global, EnviroSuite, Aerometrics, Gnosis, and Reckon. And of those companies, only 2, RPM Global and Reckon, have EBITDA margins greater than Kinatico's 13.5% FY24 EBITDA margin. So as a group, they're on average trading at a premium to Kinatico, both on an EV to sales basis, so they're 24% ahead on that basis, and on an EV to ARR basis, they're trading at about an average 27% premium. Next slide. I thought it'd be interesting to also show recent acquisition multiples, because we see companies like Kinatico with a very strong balance sheet, growing SaaS business, cash on the balance sheet, and those that are trading at a discount to valuation metrics as potential M&A targets. The average acquisition multiple paid for companies with a recurring annual revenue is 4.3 times. And if we were to apply that to Kinatico's 2024 ARR and sales, we'd come to a valuation range of somewhere between 24 cents and 31 cents, depending on which measure you use. That's substantially above the current share price of 11.5 cents. Next slide, please. So when it comes to valuing companies moving from early stage to growth stage, I prefer to use a discounted cash flow methodology. In Kinatico's case, because of the quality of the result over the past 2 years, we've reduced our discount rate used to 13.2% from 14.4%, and that resulted in our valuation lifting to 30 cents. I'll also note that obviously another measure we use within our discount rate is the LSEG's 5-year observed beta, and that has actually recently reduced to 1.41. It was previously 1.6, again because of the less volatility in the share price. Our valuation implies an EV to sales multiple of 4 times for FY25 and 3.6 times for FY26. If we do a plus minus 10% sensitivity on our valuation, on our base case forecast, that derives a valuation range of 20 cents to 43 cents a share. Next slide, please. And lastly, our modelling is sensitive to some key parameters. So I'll quickly run through where we could get it wrong, because we do get it wrong invariably. I mean, these are forecasts. They're only really what we feel we can estimate over time. So where we see the most impact on our forecast and valuation is really around our growth parameters for SaaS revenues and our growth parameters for growth and or decline parameters for transactional volumes. So we're really forecasting that SaaS revenues will become a much larger part of the overall revenues. We get to 80% by FY31. If we get that wrong, then the impact is likely to be on our EBITDA margin, because we do see SaaS revenues as more profitable than transactional revenues, even though they're recurring. So we also see an potential impact on forecasts from a slowing economy, slower enterprise customer lead times. I mean, traditionally, enterprise customers can take up to 18 months to make a decision. If that flows out, that could push out our forecasts longer term. Obviously, too, our discount rate has an impact on valuation. So at the moment, we would see if that's probably more to our discount rate is probably more likely to decline rather than increase because of obviously the improving profitability of the business. And then finally, the company has flagged that it will be investing more in increased automation. That has potential to drive down costs, and obviously that has potential to have an impact on our forecasts and valuation longer term. So that's it from me. I'll pass that back to David. Thank you very much for taking the time to listen to me.
Thanks, Finola, for your detailed analysis, for really setting the scene for the rest of this presentation. Remember, a copy of the recently released research on Kinatico can be found on the RaaS Research Group website. Now it's time to hear directly from Kinatico's CEO, Michael Ivanchenko, CFO, Jason Margach, and Chief Revenue Officer, Geoff Hoffmann. Gents, over to you, and we look forward to hearing more about the company and, importantly, its plans for the future.
Thanks, David. I'll get you to jump straight to slide 5. There we one more. There we go. So we've just announced the audited results, released our annual report for FY24, and we described it as the best result by any measure, both financial or otherwise, that the company's ever achieved. And certainly some of the key highlights down the bottom of the slide in terms of NPAT up 230%, our free cash flow from operations being the amount of cash the operation is generating, excluding our investment in engineering for future products, is now over $4 million. That $4 million is actually allowing us to invest in the future for our future growth potential without actually needing to eat into our cash reserves of $10 million to actually fund all of the things that we're looking to continue our growth and actually fundamentally expand. The way we've achieved that, and the way I suggest people think about Kinatico, is as two businesses. We've got a legacy business primarily under the brand of CV Check that many people are aware of. In fact, it is probably the strongest brand in data verification and screening in Australia and New Zealand. And right from its inception, it has built up a very strong customer base. As Finola's already mentioned, many of the corporates recurring. But it has also allowed us to not only learn from the marketplace, learn from the interactions with our customers about what they need, where the market is going, and what is needed for the future, but also has meant we've been somewhat insulated from what we're seeing in the rest of the industry, both in Australia and worldwide. I mean, if you're exclusively a verification and screening company, then it's fair to say that times are challenging. We've seen certainly other groups and companies in the sector report year-on-year reductions in revenue, declines in profitability, etc., because it is a natural evolution in a digital marketplace. The need for a middle intermediary, if you will, of somebody who can actually verify data for you, verify credentials or screening of employment candidates, is increasingly being replaced or surpassed by various digital interfaces and access to verified digital information. For us, we see that as actually an advantage as we look to play and put the context around that information for organisations, which leads into our future growth engine. But just to finish on what we refer to as the legacy part of the business, but a very important part of the business, is that it is providing us a stepping stone and a ready-made pipeline for our engagement of our new product offering, and our growth engine, which is our compliance product. So in effect, we have one side of the business where we are very focused on how do we leverage that pipeline into the future, but at the same time looking to increase productivity and efficiencies throughout the business to actually increase its accretion and cash value to the business while we actually invest and accelerate the growth business. And the growth business, as I mentioned, is around compliance. Our niche, our opportunity that we have landed on, one that we have discovered through our engagement with our customers, etc., is not directly in the assistance for organisations for them to know what their compliance requirements are, etc., but is in simplifying and reducing the overhead that they increasingly face in managing their compliance. We're seeing an increase in regulatory requirements, increases in shareholder expectations, employee expectations, both from a legislative requirement of all of the imposed tasks on organisations, but then also the daily procedural to demonstrate your risk mitigations, to demonstrate your compliance to OH&S or anti-harassment, anti-bullying, whatever it may be. We have seen that the cost to business, the time and money and effort spent in maintaining that compliance status is increasing, but has reached the point where it is well and truly material for every business, not just large regulated industries. What we have focused on, and we continue to focus on, and we can talk a little bit about that through the presentation, is all the features we are bringing in our platforms to actually reduce that overhead and that administrative burden. The simplicity is what they're valuing, the time saving is what they're valuing, and that is where we're seeing the ongoing strong demand and the evidence in the various company wins, etc., and new client wins that we're seeing, resulting in the numbers that we see there on page, the 59% CAGR of SaaS growth since launch 2 years ago. We're now up to 38% of revenue from SaaS. It started before we launched this product at circa 7. And we, as Finola mentioned, we are targeting 80% of revenue to be from the high value SaaS within 3 years. And we continue to invest in that platform to truly build out what becomes a world-class but internationally applicable solution, as opposed to the screening and data verification, which is highly localized. The simplification of your daily compliance operations is global. It applies every industry, every sector, every country, every jurisdiction. So, and as a result, the key stat that we see on the slide there, our SaaS revenue for the past year is up 90% to $9.7 million. So with that, I'm going to throw to Jason to dive a little bit more into the story about the numbers behind. And you see that it's not only last year's results, but in the 3 years that we see the trajectory that the company's been on. So that demonstration not only of the growth in what we refer to as our future company, but also the optimization of the legacy. Jason.
Thank you, Michael. Thanks very much indeed. Look, I think FY24 for us was a financial year that really underpinned the strategic transformation that Michael alluded to. I think if one has to take, there's a number of stats and highlights on the page, but I think looking at this page, I think if we take a look at it from 5 key areas of the business that we aim to focus on the outset, and the first being that on the profitability, our ability to take the business from a loss of $1.5 million back in FY22 to a just under $1 million profit for the FY24 year really attests to the effort and focus that we as a business have deployed. Michael also spoke a little bit around, and so did Finola, on the operational efficiencies. I think no more evident on those efficiency gains and the financials is sitting in the EBITDA line, our operational profit, which now sits at circa $3.7 million. Again, coming off a base of $1.1 million back in FY22. The third point here on the page really is for us as a SaaS broker. Michael's spoken about the CAGR on SaaS, but really from a SaaS perspective, a 90% increase in the year from 5.1 million to 9.7 million. And again, talking on the commencement at 2.4. So a significant achievement for us as a business. I think the fourth point in Michael's spoke of that is really on the focus on our shareholder return. Again, the 2 highlights there being the return on equities and our share price. Again, a 200 plus 210% movement. Again, highly positive for us and something we continue to strive to focus on. Last but not least on the slide really was our ability to be able to fund our future growth. Again, here, our ability to leverage $4.2 million from operational cash flow really is significant, and it's an area of focus we will continue into the future. Thank you. If we can move on to the next slide, please. Peeling back the layers just a little bit, and I think both Finola has touched on that, and we've touched on that through Michael. But again, I think significant here is the annual recurring revenue and the value of which that offers to us as a business. At a very high level, $19 million worth of transactions in the year, of which 13 million came from organizations, and 90% of which, relating to 12 million, came from a repeat purchase of that customer. For us, highly significant for a number of reasons. One is it really does lower the cost of acquisition of that customer, along with many other benefits. From a business point of view, again, adding it up onto within the SaaS realm, the collective, the 12 million plus the 9.7 million really puts us in a healthy position. Michael has spoken a little bit around the growth, but just to touch on here, if we have a look at the little graph on the right-hand side there, again, sustainable growth across all quarters for the SaaS revenue. In closing, I think a fantastic year financially for us, a year that really has cemented our foundation, and a year in which we look forward to FY25 as we continue this journey, as I said, in those 5 key areas, amongst others. Thank you very much. And with that, I'd like to hand over to Geoff Hoffmann, our Chief Revenue Officer. Thanks, Geoff.
Thank you, Jason. Just go next slide. Thank you. Look, just to touch on where Jason finished off there, our revenue numbers across SaaS, we're pretty proud of those results. $9.7 million for our organisation, for where we've come from for the last 12 to 18 months is rather significant. I'll talk a little bit about a lot of the lead indicators that sort of feed into that. I think David's comments up front, best people in the right jobs and where they need to be, that's one of the real key pieces that we help support organisations with. And I think one of the key parts in the SaaS growth that we've been driving in recent times is some of the information you'll see on this page. And I'll start off with a market research piece. Obviously, around product development and anything you're doing in marketplace, in going to market with a solution that's going to fit the needs of the customer, you need to understand what that sentiment looks like, what the needs are, what the trends are, what's the market really telling us, and in a way of finding out, are we actually heading down the right track with some of the information that's been served up to us. So we have done, let's say, tens of when it comes to interviews with customers and even people that aren't customers of ours, to understand what their challenges are in market. And as Michael touched on earlier, that whole piece around simplification continues to scream loud and come through very clearly. We've started to get an understanding around our legacy business a little bit more, and also some of the more of the enterprise side around what is our customers telling us. And our NPS has been a key part of that, where we not only collect a score out of that, but we also can collect verbatims to understand what their needs are, what's working, what's not working, etc. As you can see here on the slide, we've got an NPS score of 63, which is something we're pretty proud of, being industry averages in the mid-50s. It's an area that you're always going to continue to stay on top of, but why we continue to understand the customer's feedback and we pivot to support that, I think we'll be able to hold some good solid scores. One of the key things you'll see on the bottom of the slide is our new enterprise wins that we've had over the last 12 months. One of the key things that comes through on this slide is that we are reasonably agnostic. So where we focus on particular sectors, our solution in market is somewhat seen as a neutral solution and something that is not tied to a particular or specific industry. Some of the competitors we come up against today in the marketplace are very much industry centric, to the point where they are only specialised in aged care or they may only specialise in energy. One of our key differentials and one of our advantages is that we actually have a message and solution in market where we can be somewhat agnostic. If I can go to the next slide, please. This then sort of transitions a lot more into our existing customer base. Now, Michael touched on earlier about sort of got 2 forms of business, which is legacy and also where we're moving to with our sort of new simplification solution. And when you think about the wins that we've had on the previous slide, where they're fantastic, and we've had some really good focus on that over the last 12 months, you can't forget the importance of those blue chip brands that we continue to evolve with today. And those blue chip brands that we've got within our business, they're not anything to be looked at lightly. I mean, we've got people like Optus, Woolworths, RMIT, key brands, BHP, key Australian brands that stand out. And one of the key things as we move through the transition of bringing them through to our compliance solution is having a very, very tight, rigorous, structured go-to-market approach. And I'm not going to go through every dot point on this slide, but this gives you an idea around all the components that are put in place, lead indicators, you somewhat may say. I call it the Kinatico way of how you need to go about making sure you've got all the right components in place before you go to market and execute your solution in market. One of the key things that we've focused on over the last 12 months has been well documented is the targeted sectors that we've pursued. We focused on aged care and disability care as a start. That was also into education and energy, was where we sort of started out the last 12 months. That has somewhat evolved. I think you would find that healthcare and disability has somewhat separated in the way that we do focus on that. And those demands and needs that they've got, and Michael touched on this up front, around compliance are rather significant through to new aged care acts that have come out post-royal commissions and a whole lot of other regulatory demands that sit within that sector. No different to education, no different to energy. They've all got their challenges and their demands that come through, whether it's regulatory changes or even procedural changes they need to have within their sector. Government is of one that has probably come to us of recent times more than us pursuing it. And we've seen a rather large demand of the government clients coming to us of recent times. And they vary across Australia and they vary across different types of sectors within the government space. I suppose that it gets back to that, one of those key advantages that we've talked about being agnostic. And that's really starting to come through in the clients that we're actually in market talking to. From that, I'll pass back to Michael.
Thanks, Geoff. If we go next slide, please. So we've got a little bit about how we've gone through the change and what we've done in terms of making this migration, which I think we feel is significant over the last 2 years. Our Chief People Officer is highly focused on managing change and being very aware of how we take the organisation along for the journey. And it's actually her quote there about change isn't, or the transformation is about reacting to change, it's about deliberately shaping it. And I think that essentially sums up our approach. The data, again, speaks for itself in terms of the metrics that we've been able to achieve and sort of weaving in some of the answers to the questions that I've seen posted. One of them being that we've been able to grow SaaS revenue quickly and remain profitable, suggesting a good unit economics and strong market fit. Is that a good summation? And the short answer to that is yes, but it's both sides of the coin. We've not only proven that we have a solid product market fit, and as I mentioned at the beginning, that it's been driven by customers and direct feedback. We haven't been speculating or hypothesizing what will work. We've actually got that directly from the customers. And at the other side of the coin is, how do we ensure from the foundation up, we build that delivery and that performance around our organisation to ensure that it is accretive growth? What we didn't want to do was look at this transformation of the organisation that you see in many cases where you get an initial dip in contribution and profitability before you then go with the next phase. We were very focused on how do we drive or deliberately shape the change in the organisation, our delivery, our fulfilment, our management of that customer base, to ensure that right through that transition, we're actually seeing the expected gross margin increase across the SaaS business, which then results in those type of data points. So the SaaS per employee up 92%, the NPAT per employee significantly up 234%. Now, we have approaches and plans in place to continue that. We don't feel that we have reached an optimized state yet, so we still feel there is further work around that. Again, one of the other questions then posted there about the gross margin of transactional versus the SaaS business. Look, it's a difficult one to answer at this stage simply because of where we are in our current state of transformation and blending between the two businesses, of transforming or transitioning some of those customers in what we mentioned as the transactional pipeline over to SaaS. But the target that we have set as an organisation is to be in the mid to high 80% mark for the SaaS product as a gross margin in coming years as we continue to build out the platform. So right through the organisation, we've taken a holistic approach. This isn't we've got something new and we'll throw it out there, see how it goes, and then try and, if it is working, then we'll get behind it. The transformation through the organisation and how we've driven it has been key to achieving the metrics both across the legacy and the growth perspective. But next slide, please. So what are we doing? Like, where are we going next? And one of the big feedback we've received from the organisation, from our customers, is one of the items Geoff mentioned, which was the platform that we have is industry agnostic. It effectively manages the workflow and the management of data in an organisation, not specifically their requirements around what the particular compliance requirements are. That means we have a reasonably material integration and a deployment requirement, which in many cases we get paid for, and we have professional service teams and all that traditionally good stuff. The issue for me is meaning it takes us in some cases 3 to 4 months or in some cases bigger ones even longer, to get our larger customers live and producing revenue. A lot of our focus this coming year is all about self-service and providing intelligent tools to organisations where they will be able to self-configure and manage all of their compliance requirements over time, and then have the platform actually propagate those throughout the organisation automatically. It actually takes the simplicity to the next level, but for us it has the effect of bringing them to revenue generation point following contract signature much shorter. And so we do believe where we'll see all of those customer wins and all of the ones we've announced in the past year, where it has taken a quarter or two for that revenue to start feeding through, which is nice from the fact that we have a predictability of the revenue increase going forward. But I would like to see us get to the point, and certainly our target is where that lag for the revenue generation is shortened. We're also bringing a whole bunch of other intelligent features that our customers are asking for in terms of intelligent dashboards. And what I mean by intelligent is that not only are they able to just drag and drop and configure themselves, there is machine learning and AI built in behind them that actually recommends and highlights data and analysis across their organisation that they should be looking at, whether that's by department comparisons, whether that's site comparisons, whether that's ultimately comparison between other industry players. So you get a reference point of how you could be or should be performing versus other comparison metrics. But also we'll be adding intelligence around geolocation of compliance requirements, the ability to trigger the fact or recognise that if you're a disability care provider, will recognise the moment you arrive at somebody's location, at which point you have compliance tasks to do, whether that is verifying that you are comfortable and it's a safe environment for you to enter, whether it is that you have no symptoms or anything precluding you from doing the work, that you have the correct PPE or other equipment with you, all capturing that digitally. So we believe we strongly have product market fit, but we also have a very rich pipeline of features and a roadmap that we will continue to build out and release over this coming year. We have been quietly developing those in the background, and we will be sharing more information about those launches in coming period, when I'm very excited about that. But then on the other side of the coin, as it mentions there, we have further productivity improvements that we will roll out across the business. and really look to how we make sure that we are operating the legacy part of the business as efficiently as possible, and it continues to finance our growth ambitions. So it's a nice synergy between the two. But when you look at that as a summary, we've got 2 years of track record of proven execution, the right executive team now driving the organisation. For a small tech company with large aspirations, we're also profitable and with generating enough cash that we're not currently touching the $10 million in cash reserves. Having said that, if I have the opportunity to deploy some of that because it's going to give us some material acceleration or market expansion or acceleration of features via acquisition, then we wouldn't hesitate to use it. And along with that, a very strong balance sheet. We have no debt. Our liquidity ratio, I think as Finola mentioned, now over 2 to 1. And we also see no reason why our SaaS growth and the CAGR we've been achieving shouldn't continue. It certainly is our target. But with that, let me throw back to you, David.
Thanks for the great presentation. I always love a company that is profitable with a strong cash balance and is only just getting started. Now let's move on to the live Q&A session. As a reminder, you can submit your questions using the Q&A function on your screen, and I'll put those directly to Finola, Michael, Jason, and Geoff in whatever order that needs to be as they come through. We've got a lot of questions, so let's jump straight into it. Michael, if you're funding CapEx from cash flow, what are your plans for the $10 million you have in the bank? Are dividends a possibility for the use of this cash?
Well, dividends are not a possibility in the short term. We are, have very strong aspirations to accelerate and grow the business. And so it's actually, a very nice position to be in there to have that $10 million sitting there. I have looked at a lot of options for inorganic growth and, as I mentioned, extending the product feature set or looking at acquiring further customer bases that we could push into. At the moment, none of those investigations have met the criteria of A, not being a distraction to our current trajectory and our current approach, not being a loss leader or something that also requires a further transformation. So it's one of those ones that we will continue to review the situation, but absolutely be ready to deploy it when we feel we're in the best position to take that next step of growth. So one of the things that I'm very keen on is making sure that when we expand, whether that's looking to expand our biz dev and sales teams, or when the opportunity arises for the right international play, we've de-risked it and mitigated everything we can before we deploy our resources to take advantage of it. So the fact that it's sitting there is nice, but it is also the case that I am quite conservative about making sure that I'm highly confident we get a really good return on investment when we use it.
Geoff, good a customer question here. What are some of the issues that enterprise corporate customers are asking you to solve, and what features need to be built into the platform as a result?
Yeah, David, something we do come up against on a daily basis. I think that we're becoming probably a lot more like a trusted advisory market. And the reason being is because we're dealing with we're seeing a lot of the regulatory change and a lot of the industry challenges that are happening around compliance for all different types of organisations across different sectors. People are trying to navigate through that space, and we're finding that we're probably starting to hold the hand of the client a lot more than probably in times past, and probably a lot more than other organisations do, due to things such as the Critical Infrastructure Act, and I touched on earlier about the aged care changes, there's changes in the education sector, and as the world we live in becomes more litigious, obviously compliance is becoming a lot more layered. So we sit down with customers, and I think the main challenge that we come up against is every client's got a different need. They're all looking for the same outcome and they need to be compliant, but it's how they get there. And what I mean by that is they've got different demands and different needs within the sector they may be working in. They've got legacy solutions they're trying to navigate their way through. They've got integrations with applicant tracking systems, human capital management, learning management systems, payroll, whatever it may be. So as we sit down and understand clearly what that customer's objective is of what they're looking to achieve, whether it's through efficiencies, streamlining, most of the time simplification, to be honest, that's where I suppose the key outcomes come from. There's not one silver bullet here for each customer. I think Michael touched on earlier our time to turn around in market, that 3 to 4 months. We know the sooner we get to self-service with things such as, to your point around what a customer's looking for, self-configuration type tools where they can actually do a lot of the work themselves and go through that setup process in a very simplistic way, I think will be a huge benefit for us. But those wins that I touched on earlier, every one of those customers we've talked to, in some niche different way, they've got either a different integration or a different type of partner that they're looking to make sure that compliance works for them on. And we help support that. And I think the good thing is when you play in a certain sector for a period of time, you start to see some commonalities that start to come through. So it's been a huge win for us across some of those sectors I touched on over the last 12 months.
And maybe just an extension of that question, and the question that's come through is how long are companies taking to make their decisions to use the platform? And you touched on sort of that 3-month period. Is conversion getting difficult in this environment?
I don't know if it's getting difficult, David. I think it's more along the lines of you've got to understand really in any customer you're talking to within whatever environment is what is their objective they're looking to achieve and what's the need that they've got. And that varies, right? I mean, some people are looking for efficiencies, some people are looking for simplification, some people are just trying to get an understanding around what they need to be compliant to. Other people have got procedural compliance that sits within their business and some of the other components that Michael's already touched on. But one of the key things is our audience that we used to talk to in the legacy business has matured a lot. In the past, where you were dealing with maybe just a HR department, you're now dealing with MDs, GMs, procurement departments, broader organisations. And part of and I believe one of the reasons why we've had the wins that we've had of recent times is we've got a really strong methodology in place in understanding all the decision makers that sit within a customer, whether that's the technical user, whether it's the economic buyer, whether it is the person that's making the decision at the end of the day on the solution. They become part of the solution as we're sitting in there talking to those clients. So look, it's a pretty complex world around compliance for some people. And our goal is to get in there and not only with our tools and our product to help simplify it, but even I'd like to believe that our sales and professional services do the same thing.
Jason, I've got a cracking finance question here, and I hope you love it as much as the person submitting it. The recurring nature of the corporate transactional revenue is significant. Aside from the resulting 21.7 million of total recurring revenue, including SaaS, can you expand on how you see these recurring customers affecting the future direction and strategy, or are they just high-value transactional customers?
Thanks, David. No, look, they're certainly not just high-value transactions. I think the first consideration here is they are a significant source of input to our ever-growing simplified compliance pipeline. So that really is the first point. Secondly, they also offer a really wide perspective of what our customers are looking for. And I think Geoff touched on that, the fact that there's $12 million of revenue coming from customers. It gives us a deeper insight to what the customers are seeking and allows us then to focus our future strategy and the future builds. I think touching on the nature of the revenue itself, the verification space is somewhat crowded, or a lot more crowded than the compliance space. And I think the cost of acquisition of that dollar of revenue is significantly high in the marketplace. So for us, it offers us a lower cost of the revenue acquisition on the repeat purchases. But I think really the summary for me really is it allows us to focus on a longer term customer relation rather than a once-off revenue source.
I'm going to throw this one out there, and I'm not sure if this is a Jason or a Michael question, so if you want to put your hand up to let me know. How many customers does the 9.7 million SaaS revenue represent to help us better understand what the ARPU is?
I'll take it, Jose.
Okay.
Look, and the reason why I'll say take it, because the answer has to be put in context. The direct answer is it is between 250 customers that we've currently moved over to SaaS, or circa around that number. But that doesn't tell the full story. And the reason that doesn't tell the full story in terms of the average ARPU is because we've been winning customers at a fast rate, and those customers haven't yet generated as much ongoing revenue as they will, because they're currently coming onto the platform. And then we have customers on the platform like BHP, who are obviously very large contributors as part of that, or sort of material contributors as a percentage. So let me answer it this way in terms of our targets and where we are currently playing. The majority of our success currently is with organisations at the low end of 500 employees, but realistically 1,000 to 2,000 employees are the businesses that we are currently targeting and tracking. And again, that is because of the product nature that we have at the moment, requiring a certain degree of integration and configuration. As we release more of the self-service features we keep talking about, the plan is actually that will enable us to become more relevant for organisations of between that 100 employee up. And with the benefit that even though the ARPU for those customers is obviously lower in terms of the total customer or the full organisation return, we can actually then go much wider scale of actually getting them in with our objective that we've never spoken to them, and yet they've signed up to the platform and started using it and started deploying it. So we will continue to focus on the Kinatico way, as Geoff describes it, for our larger enterprise customers, and continue to work across those in a very targeted way. But then adding to the features in the product that we will be releasing this coming year really does open up the volume game, and that we feel contributes materially both to how it'll increase our gross margin, but also just the total rev acceleration.
This may be part statement, part question, but Michael, I'll throw this one to you as well. The fact Kinatico has been able to grow SaaS revenue so quickly and remain profitable suggests really good unit economics and really strong product market fit. Is this a good summation, or can you provide more insight on this?
So I think it is a spot on summation. What we've found ourselves in through all our discussion with our customers is, I'll keep coming back to that same point. What they're after is simplification of what is now an out of control burden. And that product market fit is why we're getting the win. If anything, my gut tells me our market economics at the moment are too cheap. And because we certainly don't get a lot of pushback on price, but we're also conscious that if I can take the land position and win the space in what is effectively a greenfield in this, the simplification of the workflow, then it puts us in a better position as we add features and functions, etc., to increase those economics. So it is we definitely have the product market fit, but we also have the roadmap knowledge of where we need to take it to the next stage.
And Geoff, maybe a question for you. Can you describe in the medium term what you envisage the compliance platform could transform into beyond the current feature capabilities it has today?
Yeah, good question. Look, I think, David, if you look at this from a customer in perspective, not product out, you would want to have a compliance solution in market that is somewhat self-serve, along the lines of anyone can set themselves up at whatever size of their business they've currently got, whether it's from a staff of 2 or 3 through to a staff of 5,000 plus. that they will be able to do that in a configured way online themselves and be able to set up the right integrations with the right partners to make sure that they can build out the ecosystem they wish to build out themselves through a full self-service model. Now, I think one of the key things that, just to give everyone context to, is we do see Kinatico to be very much a hub and spoke model. And what I mean is by that is really helping clients to be in a situation where they put compliance at the center of everything they do, and all the partners that connect into them in whatever way it may be come through that solution. And if they end up in that space in a very self-serve type way, and we then feed up the data and analytics to them in real time, compliance becomes more of an insurance policy there that realistically they don't need to worry about the admin burden to it, to some of Michael's comments earlier. It becomes a very simplified tool and something that really only flags something when I have to be alerted to something, instead of something I need to manage on a day-by-day basis. And that is what our end goal is, to make sure that a customer can get on and do their day-to-day business, and they're not sitting there living out of the life of Excel spreadsheets, etc., and trying to keep their people compliant across their business or organisation or whatever it may be. So that's where we're heading, and that's what our main goal is to get to. And that's something that we believe that we will start to be a lot closer to as we get into the new calendar year.
There's a question here.
Just to expand on that, Dave, because I think it's to really make sure that that point is clear. You know, you've got the other thing that we haven't spoken about today is obviously data privacy, data security, and the risks around that for organisations. The other thing that our solution provides is that security of data management between workers and organisations, and then the management of that data for companies, and the ability and the future vision of that is where we make that available to the broader ecosystem in that hub and spoke that Geoff's talking about, so that, you know, our worker app becomes that single point for workers to securely communicate, whether it's the interface to HR or payroll or whatever else it is, that that extension of the concept of simplification goes beyond just the compliance management, but right through the data management interaction between workers for all the tasks related to admin.
Now, I do have a number of questions still for the Kinatico guys, but Finola, a couple of questions quickly for you. What share of revenue does SaaS have on the top end of your valuation range?
Oh, thanks, David. Looking at the top end, which is 43 cents a share, implies a valuation, SaaS at 65% of our FY27 forecast, and at FY31, it's at 85%. So on our base case, we're looking at sort of 60% FY27 and 80% by FY31. If we were to get to 80% of in our forecast in 3 years' time, which is what the company is targeting, we'd be looking at a top end valuation 3 times of where we were at now for our base case. So it's quite a substantial leap on our forecasts.
Michael, I don't want you to comment on forecasts, and I don't want you to necessarily give forecasts, but do you think that's a fair assumption?
Yes.
One-word answers, love it. I do have another question for you, Finola. Why are you forecasting only modest growth in full year 25?
Thanks, David. So I always take a view in election years, and we are in an election year, both from the US perspective, because we are dealing with enterprises, or Kinatico is dealing with enterprises, and in the Australian market. So I always take the view that, and I've seen with trends, that enterprises do take longer to make decisions in election years. So just from a conservative standpoint, we've applied modest growth. I could be completely wrong, but I do think that we often see a slowdown in decision-making processes in the lead up to an election.
Geoff, a couple of questions for you. You're obviously at the coalface talking to enterprise customers. Are you seeing that or hearing that from from a customer point of view?
Look, around what's going on from a government perspective, around politics, etc., it can always be a topic of conversation. I think of recent times, we can see what's gone on with the recent sort of economy and where that has sort of had some impact across multiple industries. I think as we get into more the compliance space, though, we also got to remember these, for a lot of organisations, things are being done to them. And what I mean by that is that through regulatory change, through shifts in policy, in the next probably 6 to 12 months, you don't have to reach too far and read about the new cyber bills that are going to land through what government are going to roll out. Organisations need to adhere to that. They don't really have much of a choice. So I wouldn't say, you could throw out quotes, recession-proof and all these types of things in businesses about what we stand for. But I don't think the economy long-term in our enterprise solution and where we're going is going to have a lot of impact, if any, around our growth. And the reason being is because as the industry shifts, and as I touched on earlier, it becomes more litigious, and enterprise need to be compliant to whatever the demands are that sit across the sector they're in. That's where we sit straight in the middle of it. So, but as I touched on earlier as well, I think that one of the key things, David, is that we seem to be, through a number of organisations, advising them of things they need to think about and how they go about it through things such as the Critical Infrastructure Act. We've actually had clients turn around and say to us, after they understand what their competitors are doing in market with us, we're looking to implement something similar. So I think we're market leading there, and I don't think that really anything in the way of the economy will slow us down. But as we've got our own headwinds, as Michael touched on, got to get our customers live at a quicker rate. And we'd also like customers to sign quicker, but that's just the world we live in.
Just a couple of questions here, and I'll try and join them together. Geoff, for you, to grow your SaaS revenue, is it as simple as adding more people, or do you get a diminishing return by doing this? And the second part of that is, what role do you see third-party resellers, channel partners, or embedding with other software vendors as part of Kinatico's future growth?
Yeah, good question. So I think the first one around just adding more people, no, not at all. When you look across organisations, organisations have got demands and needs. Now, depending on the size of the organisation, the larger the volume of people that sit within that, well, that obviously comes with the revenue output. But realistically, the growth comes across us being more ingrained in more organisations, because it actually puts us back to that hub and spoke model where we become more connected in a larger ecosystem. So the more customers we are interacting with and we're supporting, the larger the ecosystem it stretches out for us. To your point around channel partners, that is on our strategic map. So we are exploring, and the conversations that Michael and I and others have had along the lines of, when do we start to bring in strategic partners? Now, there's a number you can think of that we can go and talk to, who could potentially even be resellers. But it's about making sure that we do that at the right time, in the right sort of situation of when we're ready to go to market. Now, that may be something we'll be talking a bit more about in the new calendar year, but it is definitely something that's on our radar.
We do have a number of questions, but I am conscious of time, so we may need to deal with them post-webinar individually. But Michael, last question for you. How does the company think about retaining its profitability and its operating leverage to its SaaS platform?
Look, it is something we are constantly aware of, and that it sort of ties into all of the financial position we have. Our objective is to grow profitably, right? I don't want to actually go back to a position where we're claiming we've got a growth story, but it's okay, it'll pay off once we reach there. So while there may be just minor timing issues around how we will make an investment in the short term to take that next level jump, the overarching position is that we intend to grow profitably, or be able to, in the very least, to demonstrate the exact point of return in the short term where you see that benefit of that investment. So there is going to be a time, whether it is with resellers or expansion of the sales team, etc., where we will invest to grow, and there's obviously potentially just a short-term cash hit on that. But it will be very much when we've established that position that we know, we've talked about product market fit, we've talked about the other things we've got on the roadmap, so that we know when we're investing and we're making those jumps that we're highly confident that we're going to get the return back in the short term too.
Well, as I said, that does bring to a close our Q&A session. I would like to thank everyone for your participation and great questions, and particularly like to thank Finola, Michael, Jason and Geoff for presenting today. Thanks, everybody.
Thanks, David.
Thanks for the opportunity.
I'd also like to thank each of the attendees for your participation in the webinar, and importantly, engaging in the Q&A, where we learnt a lot more about the company beyond the slides. We hope you found this webinar informative and valuable. We look forward to seeing you at our future events, where we will once again dive deep into the analysis of another promising ASX-listed stock. Watch Kinatico, follow the story, see how the business grows, and pick up on the things that Finola has mentioned. Read the research and get an insight into her views on what she thinks Kinatico will do in the future. Thanks everyone for participating, and have a great day.
Thank you very much.
Thank you.
Thank you.
Thank you.